And then, after this, dude, we'll basically get it to you in the next like week or so.
Okay, great.
So, hey, Dan, thanks so much for taking out the time and chatting with us today. Before we jump into this interview, I know we were chatting for a couple of minutes before, but we really want to hear your story on, kind of how you were brought up in real estate and where you're at today in your business, so you can give some context to our listeners.
Definitely. Yeah. So my name is Dan Perez, and I invest alongside my wife and better half, Kelly. We're both full-time W-2 employees. We're both accountants. Started in Big Four accounting and then went into private industry. Originally from Southern California, we both met in San Diego, and we recently moved to Jacksonville Beach, Florida. Once COVID hit, our jobs went full remote, and so we took advantage of moving to Florida to be closer to some extended family and for some other opportunities here. We began our real estate journey about 3 years ago in 2018, and we slowly just accumulated buy and hold rental properties in the Midwest, and those consist of single family and multifamily properties. So we've gone into both of those classes, and we've also done a handful of flips throughout our investment journey as well. As certain opportunities come up, if they don't necessarily fit our rental criteria, we'll actually quickly flip them and then take those profits and put them back into our rental portfolio. I would say where most of our success has come from is having Kelly and I both working in the business. I know a lot of our friends and competitors have one spouse or the other working in the business, and so they sometimes get bogged down with all the day-to-day operations. But we have two of us working on it, and we're both highly passionate about it. So it's allowed us to scale to a pretty comfortable amount of properties. And our ultimate goal is to get to a position where we no longer have to trade our time for money. Ideally, our rental portfolio will get to a large enough size and scale to where it's generating enough passive income to support our lifestyle and allow us to do what we want when we want with family and friends, then also be able to give back and help others hopefully achieve something similar within their lives. And I would say our why actually gives us purpose and an intentional reason for doing our day-to-day actions to help grow our business. And so again, thank you for having me, but that's a little bit about what Kelly and I do on a day-to-day.
Yeah, nice. So what got you guys to get into, investing as you were working your W-2? Because a lot of people that listen to this show, and then, even myself, I have a W-2. So what pushed you to do that? I know a lot of people are like, hey, you got to do something on the side. You got to have a side hustle and stuff like that. But, there's many things, especially these days with the internet, that you can get into. What pushed you to real estate?
We looked at other people that had a life that we eventually would desire to have when we grew up, I guess you could say, or when we got older. We don't have children yet. And so when we look ahead of us, both 5, 10, and even 20 years out, we try to look at patterns and see what are people that are in the position we want to be in, what have they done in their careers? They've all had highly successful careers, but is that all that helped them to get there? Or are there other avenues that they took? Most of them had some sort of real estate presence, whether it's extremely passive in some sort of syndication, or whether it's actively growing their single family portfolio, whatever it might be. Everyone had their hand in real estate. So that really piqued our interest early on. And we said, how do we get involved, and what part of the country does it make sense in? And so we dabbled for about a year, just looking at different markets, and we were pretty hesitant to jump in because we had a lot of family and friends that were pretty negative about it, saying, oh, you shouldn't do this, you shouldn't do that. And of course, they're the ones that have never really jumped into real estate before. So we just had to take the leap of faith and have confidence in ourselves to say, let's go ahead and do this and get involved in real estate. So I would say what pushed us to do it is we had a lot of friends, parents or grandparents or aunts and uncles that had been involved. And we wanted a lifestyle similar to theirs, where they were out at parties with family. They were out at barbecues. They didn't necessarily have to miss family events, and they were still bringing in enough income to support their lifestyle or whatever they wanted to do. And so we saw real estate as the easiest avenue for us, where we could still keep our W-2s. We enjoy them. So we could still keep our W-2s for now and take any gains we have from our day-to-day jobs and put those into real estate and let our money work for us moving forward.
Yeah. For you, how did you guys, pick that market that you're in, buying rentals, and at times doing flips? How long did it take you, to figure that out? Because I always tell people two things: either you need to find a place, and you need to have a budget in mind. So if that's a $300,000 home or a $10 million home, whatever that is, right? Find that budget, and then find that location, and then just go all in on that location and get those things, those step 1 through 5, down in that location. Then you can kind of really spread out to other areas and markets and stuff like that. But I think that's what hinders a lot of people, because there's like, they can never figure out a location, they can never figure out a price point of where they want to be. So how did you guys figure that out?
So a lot of people that I help to mentor, I tell them, don't do what we did, where we spent about a year trying to find the perfect market, and that it doesn't exist. So after knowing what I know now, going back, I think we spent far too long on trying to find the perfect market, when we should have actually spent time figuring out where can we build a team that we can rely on being out of state, to where they can help us not only take down our first couple of deals, but help put us in a position to scale once people understand who we are, what we do, and they can help facilitate growing larger than just doing a couple of deals at a time. And so we ended up in the Indianapolis market. We're also active in Kansas City and Memphis, but I would say 90% of our portfolio is in the Indianapolis market. Reason we ended up there is we were able to develop a really strong team from our general contractors. We have a couple that we work with. We have a really strong base of property managers out there, both on the commercial side and on the the residential side. We have great lenders out there. And we just have a really big network of other investors that are actually local. And whenever we just got back, we were in Indianapolis last weekend, and we go out there and we spend half the time on business, half the time on just building relationships with all the local people there. And I can get on the phone right now if we're having an issue at one of our properties, and someone will be there within an hour. So that gave us the confidence, being out of state, to say, hey, we have a team that we can rely on. Let's go ahead and go all in on Indianapolis. And that's how we ended up in that market. But you can really be successful in a variety of markets. It's not that Indianapolis is going to make us successful. It's the team that we were able to ultimately build and surround ourselves with.
Yeah, for sure. I mean, you see like David Green's book, the Core Four and stuff like that, and you're building off that and being able to, apply those principles to different locations. Yeah, I invest like an hour east. I'm in California, Orange County, so I invest an hour east, and I have same thing. Those relationships built in those areas that I feel comfortable in. So it's just making sure that you're building those relationships and knowing what those people can do in those areas, and then building upon who you've met and what they know about that area, and then ultimately putting that into your portfolio. So you guys work in W-2, being able to transition. So you guys work for the same company and then now live in Florida. Is that?
So I started at Deloitte. My wife started at Ernst & Young, and I now work for Qualcomm. So I'm in their tax department, so part of the accounting and finance department. And then she actually works for a CPA firm out of San Francisco. But we're both full remote workers.
Nice.
So we're able to get our day jobs done during the day, and then whether it's on our lunch break, before, after work, weekends, we're highly passionate about real estate. It's not a job for us.
Yeah.
There's some parts of it that I don't necessarily enjoy, like dealing with all the headaches of property management and the different issues they bring us. But overall, we really enjoy real estate, and it's actually built us an even larger friend group that we're closer with some of our investors than we are with some people that we grew up with at this point. So we see it as a hobby for us. And sometimes we have to make a point to actually set some time aside for not doing real estate. But yeah, at this point, we're still W-2 during the day and majority of the week. And then on the nights and weekends, we're trying to build the rental portfolio.
What do you think, doing that both, right? What do you think the biggest challenge is, especially building something out of state versus, doing it right in your own backyard, let's say 20 or 30 minutes away from, where you're living? What was, the past 3-4 years that you've been going through, finding a market, then, getting invested in that market and stuff like that? What are 1 to 2 things that you would say were the biggest challenges?
So what initially was the biggest challenge actually turned out to be probably our biggest success story. I would say the biggest challenge is not being able to drive the market and actually see what are we buying. You're relying on people that you have been told they're trustworthy, and you're relying on people that have good reviews or whatever it might be. But at the end of the day, it's not the same as you being able to actually go walk the property and get a visual on what the actual physical asset looks like, and what, more importantly, what the street and area look like. And so for us, that was a huge hesitation up front. But now it's great because I think we'd be far more in the details if we were to live in Indianapolis. And I think it's better that we're actually not there to annoy our teams, I guess you could say. I think for us, it's a lot better that we can be hands off now that we've built a team that we can rely on. And what we did for that, and this brings me to the second difficulty, was we didn't have enough checks and balances implemented up front to protect ourselves. We just took things at face value. When the general contractor said, yes, I've completed it, here's a photo, we somewhat blindly trusted up front. And not that we lost money or not that we got taken for a ride on anything, but now we have certain things where a general contractor will say that he's completed the work. We'll either have our agent go over, our property manager, or maybe an inspector, and just, hey, here's the scope of work. Was it completed? Was it completed well? Once they sign off on it, then we'll send the draw to the general contractor. So you learn over time how to protect yourself. And I just think having 2 or 3 people to check on things is a huge part of our business. And we've done probably 20, 30 deals with some of these general contractors, and we still have to check them just because we know they're doing large volume. They're not going to catch everything, but hopefully by having a couple people get eyes on it, it'll protect us and get us a better quality product at the end of the day.
Yeah, for sure. Yeah. I mean, those checks and balances are crucial, especially even if a lot of people go into it and they don't know, for me, like I'm not out there like banging a hammer or anything like that. And I never have been like that type of person. So you put yourself in a position where, for one, you could go out there and you could be the checks and balances, but then you're looking at something that you have no idea if it's right or wrong. So that's another challenge as well. So it's good to have those professionals that are on your side to be able to, say, oh yeah, Dan, this is good. Like, everything's good here. How long for you, you and Kelly, to like feel comfortable utilizing those professionals, vendors, all those people that you've linked up with? Was it, a couple of meetings? Was it, granted you were looking at different markets for a year, but how long until you really built that rapport, feeling like, okay, I can trust this person?
Pretty quickly. So we actually did, I think it was 10 or 12 deals before we even touched foot in the state of Indiana. Okay. we went pretty much all in, and we felt good with our team, and our team's evolved since our first couple of deals. We found people that we work a little bit better with, people that are maybe quicker at getting things done for us or more communicative across the board. But for us, I think we might have jumped in a little too quickly, but it ended up working out for us. We have other friends that started around the same time as us, and they have now done maybe 1 or 2 deals because they did have that hesitation and they weren't willing to take that leap of faith, which is totally fine. But you just have to make sure you and your spouse or you and your investment partners have the same goals and you're aligned in how you want to operate. Because if you have one partner that's maybe a little more hesitant, but you have one that's willing to take that risk and grow the business, I think you're going to have a lot of internal turmoil between the partners, and it might not necessarily end up well. But Kelly and I had enough safeguards in place where we said, hey, let's jump in. Let's see how this goes. In the Midwest, a lot of these properties are $50,000, $60,000. So it's not going to be make or break for us. If something does go wrong, we'll learn from it and adapt and pivot to what works well. But for us, we dove in pretty quickly, and we just built our team and modified it as we saw fit with each deal.
Nice. Yeah. I mean, I think that you guys, even though you took, a year to figure out that market, I think that was, for one, good, learning experience. And then 2, you probably learned some markets like, hey, if Indianapolis in the next 5 years, we don't really want to be in, now we can kind of deviate to this market or whatever that may be. Did you have any, when you were doing this, did you guys have any mentors that were helping you out, or you just mentors from afar for, maybe reading books and stuff like that?
We took the approach to have mentors that and it evolved. But at the beginning, mentors that were in the same spot that we were in, mentors that were maybe a year or two ahead of us, which proved to be probably the most helpful for us. And then we had a couple mentors that we would talk to that were maybe 2 to 5 years out from where we'd like to be.
Yeah.
And we talked, because when you have people at your same level, you can grow with them and you can figure out what are you doing that's working well, or what are some things that aren't going well that you would suggest we avoid. You can grow alongside those people, and those are some of our closest friends today. And then we had a couple guys that were 1 to 2 years ahead of us, where maybe they had 30 to 40 doors when we were first starting, and we wanted to be in that spot in a year or two. And so they helped us to scale, saying, hey, you need to build a team for where you want to be, not where you're at. And so we were starting pretty small. We were trying to get smaller boutique property managers, but then these other guys were saying, you're going to grow out of these people in a year or two. You need to just go for those larger property managers that can handle the scale that you want to be at. And I thought that was one of the best pieces of advice that we were given, was build a team that can handle and really help you grow over the next 5-10 years. Don't just build a team for where you're at today, because you're going to be constantly churning who you're working with, and you're not going to build a great rapport over time. So I think as far as mentors go, it's good to have different stages. Now with where we're at, we have newer investors that we try to help mentor. We'll answer their questions, and it helps us because it keeps us in line with practicing what we preach, still sticking. Sometimes your head gets a little big and you're like, oh, I can just underwrite this in my head and we'll be fine. But really going back to the roots and talking with new investors and saying, hey, here's how you underwrite a deal. Here's the numbers. Here's how you should account for vacancy, maintenance, whatever it might be. It helps us stay grounded with what we're doing. We have a lot of investors that are where we're at today, talk to them all the time. And then we have a couple investors that own a couple hundred units, and that's where we want to be in a year or two and really scale. So we try to maintain a relationship with people at different levels of their investment journey.
Yeah. No, that's good. I mean, you get that one hand up, one hand down, being able to, do both sides, which is huge. For, when you guys picked Indianapolis, and then now I remember you saying that you're in Memphis and KC. So why those markets outside of Indianapolis? Were there just really good deals that, were thrown on your plate that you guys took down? Or was it maybe later down the road you want to build, more rentals in those two different locations?
Yep, a little bit of both. So Kansas City, we had a couple partners from San Diego that had a 32 unit off market deal under contract. So we actually came in as an LP on that deal. And although we're not super involved with it, turned out to be an amazing deal, pretty large value add. And it somewhat motivated us to try to do one of those deals on our own and eventually be a GP, because we saw what the GPs were doing. And it was a small group. I think there's only 4 or 5 partners in it. So it's a fairly small deal, and we're all highly connected on it. It really motivated Kelly and I to say, hey, we can do this. Like that gave us the confidence to say, okay, multifamily is not some scary beast that we can never jump into. And so that helped us to grow and expand where we knew we could go with our investments. And although we're now in multifamily, we still take down singles if the deal makes sense. We're opportunists. If something pops up, we try to figure out, one, can we use it as a rental? If not, can we do a quick flip on it? Can we get in and out in a couple months and then toss that gain into another rental?
Yeah.
But so Kansas City, that's how we ended up there. We had some partners bring us a good deal and we wanted to get involved. And then Memphis, it was what you had mentioned, where Indianapolis didn't have enough deals to necessarily sustain our growth and where we wanted to be. And we had a lot of investors saying, hey, we have money sitting on the sidelines. Can we get involved in something? And so that really forced us to expand to another market, which happened to be Memphis. So we started investing there at the beginning of 2021. And we only have a handful of rentals there. But it at least gives us more deal flow and allows us to expand if Indianapolis is getting expensive, or if something's not really jiving with what we're looking for at the time, we can now go to our Memphis team and say, hey, we're looking for a couple rentals. Let's get them under contract.
Do you guys Memphis brings up a big turnkey company to me. I don't know why. I just always think about a couple of turnkey companies, especially there, in the Midwest and stuff like that. Do you guys dabble in turnkey or no? You guys, all it is, on your own dime and not having anybody else pick your properties and stuff?
Yeah. So we use the Burr Method on, I would say 95% of our deals.
Okay.
With where we're at, and with the teams that we have, we can take down the deals through a wholesaler or through, if there's a couple MLS deals that have sat on the market for a while, we'll typically reach out, and rather than just giving a low ball off the bat, we'll say, hey, what are the pain points with this? Why hasn't it sold? We'll just try to talk to the seller and say, it's clearly not selling. Is it the price? Can we give you your terms? How do we make this a win-win? So sometimes, like maybe once a month, Kelly and I will just comb through the MLS and see what's been sitting there for 90 days, 120 days, and figure out what's wrong with some of these properties. But yeah, I think for us, the Burr Method has really allowed us to grow to where we're at today. We wouldn't be able to necessarily scale if we were doing only turnkeys, just because you are leaving money in the deal. The cash flow is great as long as you have a good turnkey company where they don't sell you on something, then you have high maintenance costs the next year. But we've never gone the turnkey route. We started with the Burr Method from day one, and it's proven to be successful for us.
For people that are listening that don't really know too much about turnkey, can you explain a little bit on maybe like a last deal that you guys did that maybe a 30,000 foot view on how to do it?
On turnkey or Burr?
Burr.
Yep. So the Burr Method stands for buy, rehab, rent, refinance, and repeat. And so essentially what we do is the whole method, it evolves around hopefully forcing enough appreciation to not have to leave much capital in the deal. You're forcing enough appreciation to where the 20 or 25% down that you need to leave in the deal is all the forced appreciation, and you can get your capital back out of the deal. So for round numbers, we'll look for a deal where we can purchase it for about $50,000. We will put $25,000 into it to get it into rent ready shape, make sure that we can get a good tenant, and just make it a better house overall. So you're all in for about $70,000 to $75,000. And you go into the deal understanding that based on sale comps in that area, if you rehab it to a certain standard, it can get appraised for $100,000 on the back end. So at that point, once you're done with buying the deal, rehabbing it, you rent it out to someone, so you get a lease in place. You would go to the bank and say, hey, we'd like to refinance this property. If you run your comparative market analysis well, and if that $100,000 appraisal comes in, the bank will say, hey, we'll give you a $75,000 mortgage. You need to leave $25,000 in the deal. Well, you're only $75,000 into the deal. So the bank will give you all of your capital back. You now have a cash flowing asset, and you can go on to the next deal. The toughest part about it is you do need to have all that capital up front or be able to work with a hard money lender. Typically their rates are fairly high, but I think one thing that I've told a lot of people that I help on a daily basis, I think it's okay to take on those 10 to 12% hard money loans up front just to get your foot in the door, get some experience, because after you get some experience, those hard money rates will come down. You can typically negotiate them once you do a couple deals. And then you'll also have more people in your network that are willing to lend to you privately. That's the route we go now. We started with pretty high rate loans, but now we've gone from 12% loans 3 years ago, to now we're in that 7 to 8% range.
Yeah, that's cool. I mean, building those like the rapport with hard money lenders, and then ultimately having a portfolio of saying like, okay, well, hey, 123 Main Street and these other 5 properties, we were able to do this, and here's a package on what we've done. I've definitely had that experience, because the better you are at doing what you're doing, ultimately the more preferred rate you're going to get. So that's a huge key takeaway there is having those set up. So those relationships are just, better and better each time you do a deal. And then ultimately it comes to the point where, you're doing them cash, but then, maybe you want to take down 2 more in the same month and you don't have the cash, but you have the down payment. Then you can just call those people and, they've already worked with you. They know you and Kelly and stuff like that. So you guys can, transition that property pretty quickly. So that's huge. I was going to ask, the next question was for sure, like, okay, are you buying them cash? Then if you're not, then what do you guys utilizing? Because I know if you do, conventional financing, it takes a little longer to do the Burr Method, and you want that cash back as quickly as possible.
Right. Yeah. So we started out with the HELOC on our house in San Diego. So we were able to take down 3 or 4 deals using our own money. That was more so for us. We had people that were interested up front, but Kelly and I, we wanted to make sure that we understood the process. We got our team in place. We didn't want to look like fools in front of other people taking their money, promising one thing and delivering something completely different. So we wanted to use our own money through the HELOC. We were able to do a couple of deals, get through the full refinance process with the local lender, and then continue on. And so after we did that, we were able to put together like a pretty basic marketing packet saying, here's what we bought it for. Here's the work that we did. Here's the forced depreciation that we have. This is our strategy moving forward. Pros and cons of it. Here's what we learned. And then we went out to quite a few lenders, just whether it be family, friends, neighbors, people in our network. And we actually were denied by most people up front. They were highly hesitant of, you guys are just accountants. We've known you for years, but Dan, you do taxes. Kelly, you do financial reporting. How does this translate to real estate in the Midwest? And so we understood their concerns. And so one of our mentors said, hey, you've reached out to 15, 20 people and have had no success. Why don't you come pitch me on how are you selling this to people? So I told her, hey, here's what we're doing. And I kind of pitched her on a deal. And she said, you're essentially asking someone for basically for a favor. And when you go to these lenders, you should flip the script and you're giving them an opportunity. You're providing them another avenue to make money outside of the stock market or outside of a savings account, 401k, whatever it might be. You're giving someone a higher guaranteed interest amount to be your debt partner on these deals. And once you change how you present that to someone, they're going to take it far more seriously. And sure enough, the next couple of people that we pitched to and showed them it was an opportunity, we weren't asking for a favor, that completely changed everything. And now I would say that raising private money is our strongest suit in the real estate game.
Yeah, dude, that's a really good point. It's kind of like that going into an interview and not having a job and showing, that you really, really need the job versus, having a job and then going into an interview and saying like, if I don't get this job, then, I'm good because I'm still making income. So that's the same scenario as what you guys did is, okay, well, and it's cool that you got coached on it where it's like, okay, well, I'll go in there and basically do the same thing. I got a job. I'm good. This is why you need me. And if you don't need me, then I'll go find, Jim or Frank down the street and they'll need me because, they have money to spend and they'll be able to get a return on their money with me.
Right. Yep. And it's opened up so many doors now because at this point, we still have people that want 10 to 12%. But what I tell them is we're going to fulfill all of our 7% lenders, all of our 8% lenders, and so on. We're not going to just go straight to the highest person that has, the highest rate. We're going to use the people that give us the best rate because that gives us the best spread on our deals. And then we'll move forward. And we do have some lenders that have higher volume to contribute to deals. So that does mean a lot. Like when we're going for multifamily deals, we tend to offer a higher percentage because they need to bring a larger chunk to the deal. And now we've even added another layer to it to where, just for example, we'll offer them, hey, we can offer you an 8% quarterly payment, or this is going to be a year stabilization on this apartment complex. We'll give you 10% if you allow us to not bleed out throughout the whole process. And then at the refi, you'll get your full amount of money. And a lot of people will take that higher percentage and just get the lump payment at the refi. So it aligns priorities. We give them a higher percentage, but we don't have to constantly pay them while we're also paying all of our general contractors and getting an apartment complex stabilized.
Yeah. That's a good point too. So just for everybody listening, general partner is, running it, limited partner, limitations. You don't have all, the ability to say or dictate, what's going on. So you have a lot more irons in the fire when you're a general partner versus, limited partner, right?
Yep. Correct.
Okay.
Yeah. So as a limited partner, we're really not doing much. Since the deal that we're a limited partner on is such a small deal, they still include us in a lot of just, hey, here's the decision we made. Here's why. That helped coach us up and somewhat structure who we are as GPs now. But the only deals that we've done with other partners, we've actually structured it as a JV, where my wife and I are majority owners of the complex, but we brought in other people for strategic partnerships, whether it be to sign on the agency debt, because we had never signed on a Freddie loan before.
Hmm.
That's one of the boxes that needs to be checked is have you had a loan with us before? So we brought someone on to sign on the debt. And then we brought someone else on just as a strategic partner to help us make decisions throughout. We had about $1.5 million rehab that we did to the complex. It was a fairly large construction lift. But then after we did our first apartment complex as the main partners running it, we were then able to, hey, now that we've signed on Freddie debt, now my wife and I can go out and we can actually just take down complexes. The two of us will help us reach our goals a bit quicker. There's a time and a place for partners, but if you can take down a deal on your own and keep that equity, it helps you get to that goal a little bit quicker.
Yeah, for sure. I had this conversation earlier this morning. It really depends on, for one, what your goals are, and two, like what you're looking at as, real estate, in the next 5, 10, 15, 20 years on, where you want to be at. And ultimately, the partnership can put you in a place where you're going to have, more deals, depending on equity standpoint and how much money you have, could put you in a higher, bracket, or it could be something where you just want to do it solo and, be consistently doing it solo. And then it's going to take you a little longer, but it just really depends on what those goals are. So it sounds like you guys iron those out.
Yeah, we see a huge benefit to both. People have asked us, hey, do you prefer doing deals on your own or with partners? It depends on the deal and the time and situation. Like for us, the reason why we like doing deals on our own is you get a higher amount of equity. You're putting in the same amount of work, but you're actually keeping 100% of the benefit. So we see a huge benefit to that. But on the flip side, where the deal that we have partners in, they actually one of the guys just brought an off-market deal to us today. So we're currently underwriting that. And it's, that's a deal that we wouldn't have otherwise been a part of had we not brought him the previous deal. So it's given. Yeah. That's why you want to align with people that you're not always looking for people that can benefit you, but when you are partnering with people, you want to be sure they're not just bringing capital. What else can they bring? Can you learn from them? Can they bring you other deals? There's just so much more to a partnership than, can you bring capital? Because right now that typically is one of the easier things when it comes to putting together a deal. It's finding the deal is difficult, and if you can find someone that can help you with the deal flow, that's a huge value add.
Yeah, I think I heard from a couple of people have said this, but Ken McElroy was one of them, and he said, there's so much more money than there is deals out there, and a lot of people get fixated on, I just need $100,000 to do this deal or whatever it may be. And in reality, you can go out and ultimately raise, a couple of different friends and get that money for that deal pretty easily comparatively to the other way around, find that deal. Right. Yep. So yeah, that's a huge takeaway. Dan, for you, so what do you guys have planned in the next, 2 to 5 years? I know that you guys had some mentors set up where, they were 3 to 5 years out, and what does it look like for you and Kelly going forward? What your portfolio you're going to try to transition to or look like, and where it's going to kind of go?
Yeah. So for us, we tend to look at our portfolio or our goals based on monthly cash flow. I know a lot of people go based off of doors, which I guess you can somewhat back into a number. Like if you say, hey, we make X amount per door, then you can get to that number. Ideally, we'd like to be around $30,000 a month passive income by the time, I would say within the next 2 to 3 years. We currently sit at 250 doors, which is helping us to get to that mark, but we're not there yet. We're still in that startup phase, as far as, even though we have 250 doors across apartment complexes and single family homes, some of those are with partners, so we don't own all of them. And then a lot of them we bought distressed buildings, so they're either undesirable tenants that aren't paying, that we need to somewhat get out of the complexes, or they need a huge capital injection for rehab, and so they're either sitting vacant or they haven't been filled yet. And so right now we're still in that phase of, it's like a startup business. We're still injecting a ton of capital into it, and we're hoping that in a year or two we will be stabilized. We just finished our first full cycle on an apartment complex where we purchased it highly distressed. I think there were maybe 30% of the tenants were living there, hadn't been touched since the 60s.
Mm.
We just did a full year rehab on that. It's now at 100% occupancy, and we're closing the refinance with Freddie in about 2 weeks. So for us right now, we're still in that heavy growth phase. So we're putting any money that we make back into the business. But hopefully, we'd like to take down a complex or two a year moving forward. And that will most likely get us to our goal within 2 to 3 years. And then from there, it's not like we're going to stop everything. That's just to where we will feel totally comfortable, be able to live the life we want, and then hopefully help other people in our circle get to that point if that's where they ultimately want to be. But one thing that I find interesting is every year, I think our goals just get bigger and bigger. And I don't know if that's a personality thing or what, but if I were to look at my goals 3 years ago, where it was like, I want to take down 1 or 2 houses a year. As you get confidence in yourself and as you grow as an investor, I think your goals tend to also evolve. And so I really think our goals are just going to constantly get bigger and bigger, and we're never really going to reach them, but we'll get to a point where we are more comfortable as investors and we can have more opportunities to give back to others.
Yeah, no, that's huge. I think, having that goal in mind, going back to what I said initially, when we first started the podcast is, knowing that area and knowing the price point is going back to the basis of what those two, pinnacles are is having a goal, right? Is, knowing that area. You guys have a goal set into place, being able to have 30,000 a month, coming in on income. That's something to set your sights on and be able to get to. And then most likely when you get there, it's not really the money, it's more the challenge, right? It's more of like the drive, like to get to there versus like the other way around where it's like, I just want that cash to come in, because ultimately, if you're just looking for that cash, you're going to give up at some point along the way.
And for us, just to clarify, it's not necessarily that the money is going to make us happy. That gets us to a certain point to where we can either, like, if one of us wants to go into real estate full time, we'll have that ability. Like, that's where our comfort level would be. And the amount of experiences or type of life that we can live at that mark. I think that's what drives us to get to that point, to really be able to focus more on. It's one of those where you help yourself first and then start helping others as soon as you get to that goal. So that's how we set it. But again, that number is constantly changing, and what we want to do constantly changes as well. So who knows?
Yeah, no, for sure. I mean, it's something to set forth, and as everybody knows, goals. We didn't expect, what happened last year to happen, and then, setting those goals right is putting that carrot in front of you, and then it always, goes a little bit farther and goes a little bit farther. So ultimately, if we talk to you in 2 years, it's probably going to be completely different, but you're still going towards what ultimately you want to get towards, and those things change because either you guys have already gotten to that mark, or you're 2 months away from that mark, and then now it's set in place, a higher bar, or you guys are going to transition out of your both at a W-2 or something like that. So those are things definitely to think about as you go along your investing journey. So that's why I want to get you on, just to kind of, because you have the W-2 and I experienced the same thing, is later down the road stepping away. So okay, when do you step away, or if you do, what does it look like, and how do those goals set you up for success versus not having goals, which ultimately you're going to look back after 30 years and say, well, I should have said something so I can reach out to it and grab it.
Yep, I agree, and I think that we've had a couple friends that have left their W-2s to do real estate full time, and it's the ones that had a defined plan that are finding success. There's others that left their W-2 and they're still doing the same deal flow they were with their W-2. Not knocking them on that, but I think if I were to leave, I would want to make sure that I'm almost doubling my production, or at least validating what I'm doing, as far as whether that's deal flow or giving back to the community or whatever it is. I would want to make sure that I can substantiate that move. And it's similar to retirement. Like a lot of our parents retire and then they're like, well, what do I do now? So I think as long as you have a goal and a purpose and you're intentional about what you're looking to do, I think it'll work out totally fine.
This is kind of a different question, but did accounting help you guys on analyzing deals? I took accounting in college, hated it. Like I was so bad at it.
I did too.
but did it help you guys kind of like at least look at different deals and be able to analyze them better? Or do you feel like, after having conversations over the last 3 to 4 years of investing, like it seemed like it sets you apart?
So I think where it helped us, because it taught us a lot of parts of accounting that we're not typically involved with, and that's the bookkeeping side. I'd never done bookkeeping in my life. I'm more on, like, I help my company prepare a tax return and the 10K for financials for the investors, and it's a $1 billion company. So I'm dealing with just much larger, complicated issues. So when you get to real estate, it's a totally different type of tax. All the different incentives, loopholes, and benefits of real estate taxes, it's totally different. So it actually helped me evolve in my career, just learning more about it. I think where we really thrived was we just have like that business background to where we understand cash flow is a big thing. Like making sure, are the bank accounts funded? Do we have reserves? Just because we have money in the account doesn't mean we can go spend it on a deal, because we have to make sure if something goes wrong with these properties that we have reserves and we're able to fund whatever needs to be done. So I think that's where we really excelled in comparison to maybe some of our competitors, is we understood how the bank accounts worked, how the legal structure worked, and that really benefited us early on. But it's pretty easy to pick up after you get through one or two of them. If you surround yourself with the right team, that's the best part of real estate, is we invest alongside high school dropouts and doctors, and we're all on an absolutely even playing field, which is what I love most about this game.
Yeah, it seems like, I mean, obviously in some areas a real estate, or just, depending on who you're dealing with, we'll have people with egos, but it seems like less. I mean, at least my experience seems like less, versus like if you were, in one path and not having, so many different people, involved and entangled, and like you just said, you're dealing with doctors, there's attorneys and stuff like that over the years start investing, and everybody's kind of, it seems like it, very almost like beginner attitude, like, teach me whatever you know.
Yeah. And it's fun too, because you get on these calls and everyone has something to teach someone else. Like just because someone has, call it 1,000 units, they might have a call with you or I and say, oh, hey, Dan and Peter just taught me XYZ. Or I might have an attorney or a CPA that they could use that will benefit their business. Yeah. So that's why that's the quickest way that we were able to scale, was I set up a 15-minute meeting 5 days a week with a new investor that invested in Indianapolis. And I would just say, who are you working with? Who's your property manager? Who's your general contractor? Who's this? How can I help you as well? Like, is there something, like, if I find a deal, what are you looking for? Because I think a lot of people reach out to other investors just trying to get a bunch of information out of them. But it's refreshing when someone says at the end of the call, how can I help you? Or what can I do? Like, if you're looking for funding on a deal, can I pass along one of my private investors for you on a deal as a thank you for sharing your resources? So I think not only should you reach out to people and ask for help, but you should also offer to help them in some way as well.
Yeah, for sure. No, golden advice for sure. Dan, before we get you out of here, there's a couple of last questions, especially with, how much you've learned over the last, years of just investing. I kind of want to pick your brain to see, is there a book that you and Kelly have picked up that's really helped you to get to another level or another position in investing?
So this is the nerdy accountants in us. Tax-Free Wealth by Tom Wheelwright, which is Robert Kiyosaki's CPA. Yeah. He has great content, so we follow him and watch him on YouTube whenever he puts out new information. With the new tax laws potentially coming out soon, he's just a good guy to follow in general. But his book's really good. And then also Fake by Robert Kiyosaki is a good one. He basically goes through and tries to disprove maybe some theories or concepts you've learned throughout your life regarding 401ks or pensions or whatever it might be. It just gives you a different perspective on, hey, those might not be the best places to put your money at this time, depending on what you have going on with real estate.
Yeah, for sure. 100%. Those are both good. I've read them both. And then for you guys, is there Since you guys are doing a lot of long distance stuff, this is actually a really good question, because I don't do any long distance stuff. Is there an app or some type of system that you guys use that's an online resource that really helps the business be more efficient?
So for us, we actually do a lot of our communication with our GCs just through our phone, FaceTime or Facebook chat, Google Duo.
Okay.
We're on the phone all the time. So I wouldn't say we necessarily use a ton of apps with our team. Internally, we've used Asana in the past when we were first starting, just to make sure that we have our processes in place. And it would just help us get somewhat of a checklist put together, like when you're taking down a deal. Okay, did I order or get insurance? Did I set up utilities? Did I get the property manager lined up? There's so many different things that you have to do when you're taking down a deal. So we used Asana to ensure that we hit everything on our checklist. Now it's pretty much second nature to us, but that was a really helpful tool early on.
Yeah, I use Asana as well. And then, just being present, it's nice to have the ability to do, StreamYard like this, or, Zoom or FaceTime to be able to see something, in real time versus, okay, hey, I'll take a flight there, and be there in, 2 days or whatever it may be. So, that helps out a lot for sure.
And Trello is another good one.
Oh, yeah.
Of the managers we worked with in the past, he would just set up Trello boards for different properties and such. So that's another good one that I know other people that we invest alongside, they use that quite a bit.
Yeah. I've never used Trello, but I've heard a lot of people talk about it. I actually
Really
gotta look into it.
and user friendly.
Oh, really?
Yeah.
Yeah, I'll take a look at it. Okay, and Dan, where can people, if they want to reach out to you and Kelly, just to get some more, information or chat with you guys, kind of about what you're doing in your world of investing? How can they reach out to you?
So on Facebook, it might be, I have a pretty generic name, Daniel Perez, my wife, Kelly Perez, but Paper Route Investments is the Instagram that we have set up. And we're not as active as we should be as far as posting deals, but we do track, and we talk to a lot of investors through there. And then also that's our email account as well. paperrouteinvestments@gmail.com is probably the best way to reach me via email.
Okay, cool. Yeah, I'll put that in the show notes too, so people can get a hold of you guys. Well, Dan, dude, this has been awesome. I'm always curious to chat with people, definitely, throughout their journey doing stuff out of state. So it was cool to chat with you to see how you systematize it and how you guys are able to be successful with it. I appreciate your time. I know you guys are both so busy, so I really do appreciate you cutting out some time for us.
Thank you very much for having me.
Yeah. Have a good day.
You too.
Thanks.